In a world where a $10 bill often feels like small change, I'm here to show you its untapped potential. These companies aren't just surviving, they're thriving. Why focus on these three? Beyond their current market positions, there is a story to tell about growth, innovation, and resilience. Today, I'll make the case for all three and dive into each, dissecting their investment allure without the fluff. Straight, simple, and to the point. If you're new here, glad to see you. I'm Ian Trimble, and I talk about passive income, investing, and wealth. So if you find value in this, think about subscribing and coming back for more. I'm a big fan of investing in companies that I know and use every day. And these three make the list. All three of these stocks are currently trading under $10, and I've added them to my portfolio and plan to purchase more at this current price point. Let's start with number one, Sirius XM. You will know them as the satellite radio company. And I know what you're thinking, how is satellite radio still a thing in 2024? Well, as of December 31st, 2023, they have around 34 million subscribers and around 150 million listeners. Sirius XM has a growing portfolio of audio businesses, including its flagship subscription entertainment service, Sirius XM, and the ad-supported and premium music streaming service of Pandora, an expansive podcast network, and a suite of businesses and advertising solutions. Sirius XM reaches 34 million paid subscribers, providing music, sports, entertainment, comedy, talk, news, traffic, and weather channels, and other content along with podcast and infotainment services. Sirius XM is an attractive buy for under $10 for several reasons. It has an attractive valuation at its current trading price of $4.69, which is below the consensus price target of $4.98. This implies a forecasted upside of 6.1% from the current price. Sirius XM has consistently generated positive free cash flow, demonstrating its ability to generate revenue and manage cost effectively. With approximately 34.6 million subscribers, it has a stable revenue stream from subscription fees, which I like in a company. If you can keep the steady stream of income, this will make it possible for Sirius XM to make strategic acquisitions in the future and increase their market share. Speaking of income, in the fourth quarter of 2023, the company generated $445 million in free cash flow. As a leader in satellite radio services, Sirius XM enjoys a strong market position. Its services are widely used in vehicles across the US and Canada, with radios pre-installed in many light vehicles. There is still the potential for growth with the purchase of Pandora Media from 2019. For the dividend investors, Sirius XM offers a dividend yield of 2.40%. In summary, Sirius XM current price, combined with its financial stability, market dominance, and growth potential, make it an intriguing investment opportunity for those seeking value and potential returns. Pick number two is Redfin. Right now, there's a terrible housing market. With the current interest rates at around 6 to 7%, many new investors are playing the waiting game. They're waiting for Jerome Powell to signal the next rate cuts, which might happen in the summer of 2024. In the meantime, people still want the dream of home ownership. Well, Redfin changed the game with their technology offerings. In fact, I purchased my latest home through Redfin, and the experience was great. It was super easy for me to put in my specifications and have available homes come back. I'm even using them now to look for my next long-term rental opportunity. If you want me to make a video about that, let me know in the comments. One thing that I loved was their agents are paid on salary and not commission, so they don't have the need to sell you something you're not interested in or you can't afford. Redfin offers lower commission rates than traditional brokerages, saving sellers a significant amount on commission fees. This has introduced price competition in an industry that previously saw little variance in commission rates. This brings us to today, where Redfin shares have declined by nearly 30% this year already, and the stock is hovering around $7, which means the stock is trading at a discount compared to its consensus price target of $8.06, implying a forecasted upside of 15.1% from the current price. Redfin is embracing the AI craze with its AI-powered tool called Ask Redfin, whose goal is to quickly answer questions about for sale homes. Robinhood currently has around $193 million cash on hand, which should help it weather this turbulent market until there is a recovery. Redfin still has some positive things going for it, even though their share price has dipped 30% since the start of the year. And that's what makes it exciting for me. I'm a long-term investor, and I love the fact that according to their latest presentation, Redfin is the #1 most visited brokerage website, which generates 5 times the traffic of their next biggest competitor. They offer a complete customer solution, including brokerage, rentals, mortgages, and titles, so they can help you at every step of the housing portfolio. If I ever decided to sell one of my homes, it would probably be through Redfin because of their 1% listing fee. In 2023 alone, Redfin saved home sellers $127 million. This is why I think Redfin is a real bargain for the investor who is looking to save some change and look towards the future. The final pick on my list of bargains under $10 is Warner Brothers. Chances are that you have interacted with Warner Brothers in some form or another. They own Warner Brothers Entertainment, which is home to franchises like Harry Potter, DC Comics, and Looney Tunes. If you're a Game of Thrones and House of Dragon fan like myself, then you're going to be watching it on Max when it returns later this year. Warner's also owns CNN, a global news network offering 24-hour coverage of current event, politics, and more. When I was a kid, my dad asked me one time, "What does CNN stand for?" He replied, "Contains no news." I thought that was funny, and that joke still hits to this day. Anyways, back to the stock. It is currently trading around $8.73 a share, which makes it a bargain if you consider that the analyst average rating for Warner Brothers Discovery stock is a buy, with a 12-month price forecast of $15.39. Part of the reason why the stock took a hit this past year is that studios' revenues decreased 18% compared to the prior year, and content revenue decreased 20%. TV revenue declined significantly, primarily due to the impact of the Writers Guild and SAG-AFTRA strikes. The good news is that they did have some hits after the strikes ended, with recent releases like Wonka, Aquaman and the Lost Kingdom, and the latest film, Dune 2. Seriously, go see Dune 2. It's that good. After you watch this video, and give it a thumbs up and consider subscribing. The Harry Potter game, Hogwarts Legacy, was also a hit, and the game found a new lease on life with the Nintendo Switch. Warner Brothers Discovery also plans to increase its revenue by cracking down on password sharing of its Max service, following Netflix's success doing the same thing earlier. I enjoyed my mom's account while it lasted. Warner Brothers also plans to overhaul some of its existing brands like True TV and will shift its primetime lineup to a new sports slate this coming summer. As you see, Warner Brothers Discovery is not standing still and is working hard to get that share price back up. So there you have it, 3 value stocks all under $10. As always, if you like this video, please give it a like and consider subscribing, where I will talk about the best stocks for Lyft drivers. Leave it on the comments, and I look forward to talking to you again in the next video.